Silver isn't going up anymore. It is threatening to break the social contract between paper pricing and physical reality. And the crowd that needs stability is already trying to talk this move back down. They'll call it froth. They'll call it a crowded trade. They'll call it a blow-off. But that's not the part that matters. The part that matters is the hidden mechanism most people never look at. The price of time inside the silver curve and what it forces the biggest players to do when the calendar stops being flexible. And before this is over, you're going to have a clean checklist, levels, timeline pressure points, and the exact signals that confirm the thesis or break it, so you're not guessing in the middle of the most emotionally violent market on the board. Here is the uncomfortable truth about the $1,000 silver nightmare. It is not a prediction. It has a description of what can happen when a thin market gets shoved into a corner by constraints that don't negotiate. People hear 1,000 and they picture a straight line. They picture a victory lap. That's fantasy. The nightmare is the path, the gaps, the margin spikes, the sudden no offers, moments where the screen says one thing and the real world says something else. Because in a market like silver, the price isn't the story. The price discovery process is the story. And once that process starts to fracture, normal playbooks stop working. But that's not the part most people are watching. Most people are staring at spot like it's a scoreboard. Meanwhile, the professionals are staring at the plumbing, the spreads, the delivery windows, the inventory categories, the options positioning. Because in metals, especially silver, the fight isn't only about direction, it's about who can survive the process. And the reason this matters right now, not someday, is simple. The calendar turns optional demand into mandatory demand, and silver has a way of making deadlines very expensive. Let's ground this in the present without getting hypnotized by the print. As of this week, silver has been trading in the kind of elevated headline-grabbing zone that changes behavior, roughly the neighborhood of the high double digits per ounce, bouncing hard enough day to day to remind you this is not a sleepy market anymore. That range matters, but the velocity matters more. When a market that normally breathes starts sprinting, you're not looking at enthusiasm. You're looking at a change in who is setting the marginal price. And when the marginal buyer shifts from idyllic exposure to I need the metal or I need to cover, the entire character of the tape changes. You can feel it. Liquidity thins, spreads twitch, pullbacks get bought faster. Then the air pockets show up, and that's where the real pressure starts. Now, the conflict that's driving this isn't mysterious. It's structural. Futures traders price time. Industrial buyers price risk. A fund can roll a contract. A manufacturer can't roll a production line. A macro trader can reduce exposure with a click. A procurement desk that missed a supply window can lose a quarter. So you get this quiet war inside the market. The paper side wants the story to stay orderly because orderly markets are hedgeable. The physical side doesn't care about your story. The physical side cares about delivery, lead times, financing, and whether the metal is actually in the right place at the right time. And when those two worlds diverge, the mainstream commentary misses the signal because it's watching the wrong screen. Here's the hidden detail that reframes everything. In silver, the most honest signal is often the price of immediacy. What the market charges you to get metal now versus later. That's term structure. That's the futures curve. And if you understand it, you stop getting emotionally whipsawed by headlines because you're watching what the system is forced to do under stress. But the next detail is what flips the whole setup. Term structure sounds like jargon until you see what it implies. In a normal world, future delivery costs a little more than immediate delivery. Storage, insurance, financing, the cost of carrying inventory, those things push forward prices up. That's contango, and it's boring. Backwardation is the opposite. Backwardation is when the front month is expensive relative to later months. In plain English, the market is offering a premium for immediacy. It's saying, I will pay you extra to hand it to me now. That doesn't happen because traders got emotional. It happens because someone is willing to pay up to solve a timing problem. And timing problems are where squeezes are born. Now, backwardation alone isn't a guarantee of anything. It's a condition, a pressure gauge. But when you combine backwardation with elevated volatility, visible investment inflows, and a market with known supply constraints, you're looking at a setup where the cost of being short time can explode. And yes, I said short time, not short price, because a lot of shorts in commodities are not directional villains twirling a mustache. They're hedgers, they're dealers, they're entities that are short because that's how they manage business risk. The problem is when the curve goes the wrong way, their hedge stops being a hedge and starts becoming a cash flow problem. And cash flow problems create forced behavior. Forced behavior creates trend. Let's talk inventories, because this is where people get lulled into a false sense of security. You'll hear there's plenty of silver in warehouses, and that might even be true in a broad sense. But in the delivery ecosystem, not all inventory is the same. There's a difference between silver that meets specifications and sits in a warehouse, and silver that is actually available to be delivered against futures contracts at the posted price. In many metal systems, the jargon is eligible versus registered, but don't get hung up on labels, get hung up on the concept. Eligible is basically metal that could be deliverable if the owner chooses to make it deliverable. Registered is metal that is already designated and warranted for delivery. That distinction matters because in a tight moment, the market doesn't need theoretical supply. It needs deliverable supply. And when deliverable supply is scarce, the paper price can get dragged around by a surprisingly small amount of physical friction. But that's not the part that matters. The part that matters is what happens when the calendar forces a choice. Futures markets have delivery months, notice periods, roll windows. There are times when you can float. And there are times when you have to settle the question, do you deliver, do you roll, do you close, or do you pay up to avoid the headache? Those time gates turn, I will deal with it later, into I have to deal with it now. And that's why you see weird behavior around contract transitions, liquidity pockets, sudden spread moves, and bursts of volatility that feel like they came out of nowhere. They didn't. They came out of the calendar. So when you hear people say silver is manipulated here as the finance literate version that doesn't too require cartoon certainty, silver is a market where stability is valuable because volatility is expensive to hedge and politically awkward when it hits consumer-facing industries. The incentive is always to keep the narrative calm. Even funds have an incentive to keep it calm because calm markets keep leverage viable. But calm is not a decision you get to make when the curve says, now, inventories say, not enough deliverable, and options positioning says dealers will have to chase. And that's where the real pressure starts. Let's bring options into this, because it's one of the most misunderstood accelerators in modern markets. When a lot of call options are bought, dealers often hedge that exposure by buying the underlying futures. If price rises, the hedge requirement can rise too, which creates reflexive buying. That S-delta hedging in human language, the market S-risk managers, become buyers as the market goes up, not because they're bullish, but because they're managing exposure. In high gamma environments, where small price moves change, hedging needs quickly, you can get feedback loops. Price rises, hedgers buy. Price rises more, hedgers buy more. It's not magic, it's math. So one of the cleanest explanations for why some moves feel like they shouldn't be happening. The next detail is what flips the whole setup. In silver, you can have an options-driven surge on top of a physical timing problem. That S when the tape stops behaving like a normal commodity and starts behaving like a stress test. Now stack the proof. You don't want one argument. One argument is a story. You want a pile of mechanisms pointing the same direction. So let's stack this like a professional would. First layer, the curve. When the front of the curve is bid relative to later delivery, it's telling you someone is paying for immediacy. That's a tightness signal. Second layer, inventories with categories. If deliverable supply is not growing in a way that matches demand stress, the curve's message has teeth. Third layer, flows. When investment vehicles, ETFs, and similar products see rapid inflows, that doesn't automatically cause a squeeze, but it becomes a demand shock layered on top of an already sensitive system. It turns the physical supply chain into a stress test. In a calm market, inflows are absorbed. In a tight market, inflows force sourcing decisions. Fourth layer, industrial behavior. Silver is not just a monetary metal, it's an input. Solar, electronics, specialized applications, whatever the dominant industrial channels are in the moment, they share one thing. Procurement hates uncertainty. Procurement pays for certainty. When price is stable, procurement optimizes cost. When price is unstable and the curve screams now, procurement starts optimizing for continuity. That often means buying earlier than usual, buying more than usual, or locking in supply in ways that remove metal from the spot ecosystem. And that is exactly how tight markets get tighter. Fifth layer, global frictions. Silver doesn't live in one place. It moves across regions. If one region starts stockpiling, if trade policy threats change behavior, if logistics bottlenecks hit refining and shipping, you can create local scarcity that pulls on global pricing. This is where arbitrage matters. If the price in one hub diverges from another, traders attempt to move metal to capture the spread. But arbitrage has lead times and costs. In a fast market, arbitrage doesn't instantly fix the problem. It can actually amplify the scramble because everyone is trying to do the same move at the same time. And if you've ever watched a door get crowded when everyone tries to exit at once, you already understand what happens next. Sixth layer, positioning and leverage. When the market is crowded, long or short, small moves get amplified by margin. If price swings hard, some participants are forced to reduce exposure, not because their thesis changed, but because their risk limits did. That can create cascades in either direction. And in silver, Cascades are the feature, not the bug. But that's not the part that matters. What matters is that these layers are not independent. They interact. A curve that prices urgency pressures shorts and roll traders. That pressure can be amplified by options hedging. That amplification can trigger margin stress. Margin stress can trigger forced buying or forced selling. Forced buying collides with physical constraints and procurement urgency. Then liquidity disappears at exactly the wrong moment. That is how you get the nightmare path, where the destination becomes almost irrelevant compared to the volatility of the journey. Now, let's talk supply, because this is where silver is different from the mental model most people use. A lot of folks think higher price equals higher supply. That's true for some commodities with flexible production. Silver is less flexible than people assume. A significant portion of silver supply comes as a byproduct of mining other metals. That means even if silver's price rises, you don't automatically get a clean surge in new silver production. The incentive to ramp is diluted because the primary economics might be driven by something else. And even when primary silver projects exist, mining is not a faucet. Lead times are long, permitting is slow, capex decisions are cautious. Refining and logistics have constraints. Recycling helps, but recycling has its own friction. Collection, processing, and the fact that recycling responds to price with a lag. So the supply response is slower than the narrative wants it to be. And slow supply response in a market with urgent demand is how you set up persistent tightness. The next detail is what flips the whole setup. Once buyers believe supply won to respond quickly, they start buying earlier. That pulls future demand into the present. And when future demand gets dragged forward, the curve tightens more. Reflexivity. Now macro. Silver is a strange beast because it's both an industrial input and a monetary symbol. That makes it more volatile than gold in many regimes. When real rates fall, when the dollar weakens, when inflation expectations tick up, when debt worries creep into the mainstream, silver can catch a bid as a monetary hedge. At the same time, industrial demand can remain sticky even when macro looks messy, because some end uses are not optional in the short term. But silver also has a nasty habit. In broad market crashes, it can get sold brutally because it's liquid and leveraged players need cash. So you must hold two truths at once. Silver can be the asset that rips in a monetary stress regime. And silver can be the asset that gets punched in the face in a deleveraging event. That's why anyone promising you a smooth ride is selling you a bedtime story. So how does $1,000 even enter the conversation without sounding like a meme? You treat it as a tail scenario where the unit of account is changing and the market structure is failing at the same time. If the world slides into a regime where currency confidence is under stress, where capital controls and trade frictions distort flows, where commodities are strategically hoarded, and where the paper market's ability to promise future delivery is questioned, then price is not just a reflection of value. It becomes a rationing tool. In that world, the number on the screen can become an emergency signal rather than a balanced equilibrium. That doesn't mean $1,000 is your base case. It means the distribution of outcomes gets a fat right tail when the plumbing is stressed. And that is exactly why you don't dismiss the idea just because it sounds extreme. Extremes are how thin markets express stress. But let's be equally honest about counterpoints, because trust comes from acknowledging what can break your thesis. Counterpoint 1, demand destruction. At very high prices, some industrial users can thrift, substitute, redesign, or delay. Not instantly, but it can happen. Higher prices can also slow discretionary investment demand. Counterpoint 2, policy and margin. Exchanges can raise margin requirements. That can crush leverage longs and create violent down moves even in bullish structural setups. This is a big deal in silver, always has been. Counterpoint 3, recycling response. Sustained high prices can pull more recycling into the system. That can ease tightness over time. Counterpoint 4, macro shock. If you get a sudden liquidity crisis, silver can drop hard with everything else because forced selling doesn't care about your long-term thesis. Counterpoint 5, curve normalization. If backwardation relaxes, if spreads stop screaming, if deliverable inventories rebuild, the now pressure fades and the market can cool dramatically. Those are real. They're not bare propaganda. They're the checklist items that keep you sane. Because if you're going to play in a market like this, you need an invalidation framework. Not vibes. Now let's talk about what you should actually watch in the next week or two. Because this is where most people get lost. They watch price like a soap opera. You want to watch the things that force behavior. Watch the front month versus next month spread. You don't need to become a curve wizard. You just need to notice whether the market is paying up for immediacy or relaxing back into normal carry. If the premium for now persists or expands while price consolidates, that's a bullish stress signal. It means the market is not being given relief by time. If the spread collapses and the curve normalizes, that's a warning the tightness narrative is cooling. Watch signs of deliverable inventory stress. Again, you don't need perfect numbers. You need direction and context. If deliverable categories appear constrained while demand narratives stay hot, that matters. If deliverable supply visibly rebuilds, that changes the math. Watch ETF-type flows, but interpret them correctly. Inflows during a calm period are less meaningful. Inflows during a stressed curve are gasoline. Outflows during a panic can be air pockets. The flow is not good or bad by itself. It's a pressure multiplier. Watch implied volatility and option strikes that act like magnets. If implied volatility rises and price keeps grinding higher anyway, it suggests demand is strong enough to absorb hedging costs. If implied volatility spikes and price starts failing at key zones, it can signal the market is getting too leveraged and vulnerable to a margin-driven shakeout. And that's where the real pressure starts. Now, levels. I'm going to give you zones, not magic numbers, because silver loves to stab precise levels and punish anyone who treats them as sacred. In the current regime, where silver has been trading around the 90 to 95 area, your psychological checkpoints are clean. The round number century mark above and the big round number zones below that represent prior consolidation shelves. If silver can hold above the most recent breakout zone on pullbacks, think the last major Tomoku base it launched from, that Logos the controlled retest scenario. If it loses that shelf and closes weak for multiple sessions while spreads relax, that's your first thesis warning. If it loses the deeper consolidation zone from earlier in the move, and the curve normalizes, that's a stronger invalidation that the market is transitioning from structural bid to speculative unwind. And if you see that kind of unwind, it can be savage even if the long-term case remains intact, because silver doesn't correct politely, it corrects violently. Now, here are the two scenarios you need burned into your brain, because this is how you stay rational when the tape tries to hypnotize you. Scenario 1 is the controlled pullback and retest. Price cools off, maybe drops hard intraday, scares everyone, then finds buyers at prior breakout zones. The curve stays relatively tight. The spreads don't collapse, the market breathes, but doesn't break. That scenario is bullish because it shows that dips are being bought by participants with patience and conviction, not just by leverage. In that scenario, a move toward the psychological $100 area becomes more likely, and if $100 breaks and holds, you can get acceleration toward the next obvious zones above, levels where profit-taking and dealer hedging dynamics can collide. And if those levels break, the math changes. Scenario 2 is the continuation squeeze with gap risk. Price doesn't give you the friendly pullback, it grinds higher, then jumps. Liquidity thins, especially around off hours and weekend transitions. Spreads stay stressed. Options hedging becomes reflexive. Shorts and underhedged participants are forced to chase. In that scenario, you can get a fast move through $100 that feels irrational, and that's exactly why it happens, because the market is not trying to be rational. It's trying to clear risk, but this scenario comes with a warning label. Continuation squeezes often end with volatility weapons, sudden margin hikes, sharp intraday reversals, news catalysts that are used as excuses. If you're not emotionally prepared, this is the scenario that steals your edge by making you buy highs and sell lows in a blur. And that's the part that matters most. So let's build the psychology shield, because without it, none of the mechanics matter. In a market like this, you're going to be emotionally manipulated by volatility, and not because anyone is targeting you personally, because your brain has predictable failure modes. When price whipsaws, your brain confuses intensity with information. A big red candle feels like new reality, even if it is just leverage getting rinsed. A big green candle feels like now or never, even if it's just hedging flow. The market loves to create false urgency at tops and false despair at bottoms. And silver is elite at this. It will drop hard to make you feel stupid for being bullish, then rip to make you feel stupid for being cautious. The point of the shield is not to eliminate emotion. It's to prevent emotion from making your decisions. Here's how you do that in practice. You separate trend signals from noise. Trend signals are structural, a stressed curve, persistent demand, inability of supply to respond quickly, sustained bid on pullbacks at key zones, and confirmation through cross-market behavior. Noise is intraday chaos, headline-driven spikes, and liquidation cascades that reverse as fast as they appear. If you can't explain a move using a mechanism, margin, hedging, spreads, calendar inventory, treat it as noise until it proves otherwise. Because if you don't, you'll spend your entire week reacting instead of thinking, and you give yourself an invalidation line, not a feeling. A line. If the market does X, your thesis is wrong or at least delayed. That S, how you avoid the trap of just one more dip in a falling knife. In silver, invalidation is often not just a price level, it's a combination. Price breaking key shelves and staying weak while the curve relaxes and stress indicators fade. When both happen, the market is telling you the urgency has left the building. Listen, because if this one level breaks, the math changes. Now, back to the nightmare. Why is it called that? Because the nightmare is not only upside, it's the way upside and downside alternate like a weapon. The nightmare is the way silver can be absolutely right on the thesis and still punish you with a 15% to 25% drawdown in the middle of the move. The nightmare is the way liquidity vanishes and your execution gets worse exactly when you need it most. The nightmare is the way the market can move on a Sunday open or during thin overnight hours and you wake up to a new regime. That is not a moral statement. It's a market structure statement, and that's why the calendar trigger matters so much. Weekends create gap risk, month-end and quarter-end create rebalancing pressure. Option expiries can change hedging flows. Delivery windows can turn spreads into sirens. These are not trivia. They are catalysts that force participants to act, even when they'd rather wait. If you know the calendar, you stop being surprised by random volatility. You start anticipating where liquidity will thin and where forced behavior is most likely to show up. But the next detail is what flips the whole setup. Once enough people anticipate the same window, they front run it. That pulls pressure forward. That's how you get moves that start earlier than you expect and end faster than you can emotionally process. Now let's translate all of this into a near-term roadmap you can actually use. If silver holds its recent high zone and consolidates without the curve relaxing, you respect the upside continuation risk. In that environment, the first major psychological battlefield is the $100 area. A clean push above, followed by holding it on a retest, is the kind of event that changes who is willing to allocate. It becomes a headline. It becomes a benchmark. It becomes a line that risk committees have to talk about. And when committees talk, flows follow. Not instantly, but mechanically. If silver fails at the highs and sells off hard, your job is not to panic. Your job is to watch where it stabilizes and what the curve does. A sharp drop with a curve that stays stressed can be a liquidation flush, not a thesis failure. A sharp drop with spreads collapsing and stress fading is a different animal. That's the market telling you the urgency was speculative and is being released. In that case, the nightmare shifts from upside squeeze to downside cascade. And if you can't tell the difference, the market will teach you the hard way. And if silver rips through $100 and keeps going without giving you a pullback, the move is likely being driven by forced behavior. Hedging, short covering, procurement urgency, or some combination. That's when you tighten your discipline, not loosen it. Because when the tape gets euphoric, your brain starts writing checks your risk tolerance can't cash. That's where the real pressure starts. So what about targets? Here's the clean way to think about it without turning this into a fantasy pitch. In a continuation scenario, once $100 is convincingly in the rearview mirror, the next targets are not mystical. They're the zones where prior market memory, option strikes, and psychological round numbers cluster. That could mean quick extensions into the teens above $100, then potential air pockets and retraces, then further extensions if the plumbing stays stressed. In a true squeeze, silver can overshoot any reasonable target because reason is not the clearing mechanism. The clearing mechanism is forced buying colliding with thin offers. That ISY $1,000 exists as a narrative because the right tail is not bounded by comfort. But your base case targets should be rooted in structure, not imagination. And your invalidation should be rooted in stress signals fading, not in vibes. Now, let's address the skeptic's question directly, because a lot of smart people are rolling their eyes right now. If silver is so tight, why isn't it already at some absurd price? Because markets can stay mispriced longer than you can stay leveraged, and because supply chains don't break all at once. They strain, they adapt, then they hit thresholds. Also because paper markets are excellent at smoothing volatility until they aren't. The price can lag stress because participants can borrow time through rolling, leasing, substitution, and financial engineering. But those tools work best when the curve behaves. And when the curve starts charging for immediacy, time becomes expensive. And when time becomes expensive, the system starts choosing between two costs: pay up now or risk paying much more later. That is the psychological pivot point. That's where the real pressure starts. If you take one thing from this, let it be this. Silver is not a story trade right now. It's a structure trade. And structure trades don't require you to be a prophet. They require you to be a mechanic. Watch the curve. Watch deliverable supply signals. Watch options and volatility. Watch whether dips are being bought with conviction or being held up by leverage. Watch the calendar windows. And always, always respect the possibility that price can whip around violently even if the thesis is correct. Because in silver, volatility is the language the market uses to transfer metal from weak hands to strong hands. Near-term checklist, in human terms. If you see silver hold above its recent breakout shelves on pullbacks, while the curve remains tight and volatility stays elevated, the bullish structure remains intact. If you see silver lose multiple key shelves with spreads relaxing and stress indicators fading, the market is telling you the urgency is cooling, and you treat it accordingly. If you see a sharp spike higher through $100 with no breathing room, you assume forced behavior is involved, and you manage yourself like the market is capable of snapping back just as violently, because it is. And here's the subtle CTA, not a plea. If you're the kind of person who'd rather understand the mechanism than chase the headline, if you want to be early to the signal and late to the emotion, then stay close to this conversation. Because this is exactly the kind of market where the crowd gets loud right at the wrong time. The advantage isn't having more confidence. The advantage is having a cleaner process. Silver might not go to $1,000. It might never need to. The point is that the market is currently behaving in a way that makes extreme outcomes more plausible than people want to admit, because the plumbing is under stress and the calendar is not your friend. If the curve keeps pricing urgency, if deliverable supply stays tight relative to demand, if options hedging continues to act as an accelerant, and if macro keeps feeding the bid, then the nightmare isn't a number. It's the way the market moves. And if you can read the pressure instead of reacting to the candles, you don't have to be the person who learns that lesson at the top or at the bottom. You can be the person who sees what matters before it's too late.